All right, let's dive into Carter's. Their recent Q3 earnings call was, well, a real roller coaster. We saw a pretty mixed report and a brand new CEO who's not wasting any time rolling out a seriously ambitious turnaround plan. So let's break it all down.
So the first thing you need to know is the market's instant reaction. Right as the numbers hit the wires, before the market even opened, the stock just tanked, dropping nearly 9%. That's a huge move. And it tells you Wall Street's initial take was, well, not great.
So why the big drop? It was a classic mixed bag. On one hand, they actually beat on revenue, which is good. But on the other, their adjusted earnings per share missed the mark by about 5%. And that kind of disconnect, beating on the top line but missing on the bottom, is exactly what gets investors confused and, gets them selling.
But, as the dust settled and people started digging in, the real story began to surface. And that story is all about management's aggressive new playbook. This is not a company that's just sitting back and waiting for things to get better. Nope, they are making some big moves.
The new CEO, Doug Palladini, he's only been on the job for about 7 months, and he came out swinging. This quote right here says it all. He's basically telling investors, look, I know this isn't good enough, and we are about to make some major changes.
And here is that plan. It's a 3-part attack aimed at finding $45 million in annual savings. First up, they're closing about 150 stores that just aren't pulling their weight. Second, they're right-sizing, which means cutting about 15% of their office staff. Both of these are pretty drastic steps, all designed to unlock savings and get profitability back on track. This isn't just trimming the fat. It's a deep structural overhaul.
And if you're wondering where that $45 million is coming from, well, here you go. The lion's share, about $35 million, is from that organizational restructuring, the headcount reductions. The other $10 million is from general SG&A, which is just the cost of running the business. This really shows you they're going after their fundamental cost structure, not just nickel and diming things. Okay, so that's the internal plan. But here's the kicker. While they're busy trying to fix the ship, there is a massive storm brewing on the outside. And that storm has a name: tariffs. This is, without a doubt, the single biggest headwind they are facing.
And to really get a sense of how big this problem is, just look at this chart. Historically, Carter's paid an effective duty rate of about 13%. Now, with these new tariffs, that rate has literally exploded to nearly 40%. We're talking about their tariff costs basically tripling. It's a huge, huge deal.
So what does that look like in actual dollars? Well, before they do anything to fight it, Carter's is looking at a potential annual hit of up to $250 million. Suddenly, that $45 million savings plan, while absolutely necessary, starts to look a whole lot smaller when you put it next to a $250 million problem.
So you've got this bold internal plan on one side and a massive external threat on the other. How are we supposed to think about Carter's from here? Well, here's our take.
Really, the whole investment case for Carter's boils down to this one question. Can all their aggressive cost-cutting and other actions be enough to offset the absolutely crushing weight of these new tariffs? That's the whole ballgame right now. Let's break it down into a bull case versus a bear case. For the bulls, you've got a proactive new CEO. You've got that decisive $45 million plan, and believe it or not, their own retail stores are actually showing some strength. But for the bears, well, you've got that monster tariff impact. You've got severe pressure on their margins, and their wholesale business continues to be a weak spot. It's a real tug-of-war. So after weighing all of that, our call is a market perform. Look, we're really impressed with how fast and how big management is moving with this restructuring, but that tariff headwind is just too massive to ignore. For right now, all the potential good from their internal plan is being completely canceled out by this huge external risk. And what does that mean for the stock price? Well, for the near future, we think it's going to be stuck in a range. The market has pretty much priced in both the good news, the savings plan, and the bad news, the tariffs. Now it's a waiting game. Investors are going to want to see proof. They'll need to see those savings actually show up on the bottom line and see if Carter's can really pass on some of those tariff costs to customers. And as for what's next in the fourth quarter, management is actually guiding for a little bit of growth in their U.S. retail stores, which is good to hear. But they also gave a warning. They said the pressure on their gross margins is probably going to get even worse than what we just saw as the full impact of the tariffs really starts to hit home.
Okay, so finally, let's talk about a potential trade idea. And just to be clear, this is not financial advice. Think of this more like we're pitching an idea to our investment committee based on everything we've just discussed. The idea here is what we'd call a relative value play. What that means is we're not necessarily betting that Carter's stock is going to soar in price.
Instead, we're betting that it's going to do better than its competitors. So the trade would be to go long Carter's while at the same time shorting a basket of similar companies.
So what's the logic? Well, pretty much the entire retail sector is getting hammered by the same tariff problems. But what makes Carter's different right now is this aggressive internal plan. That $45 million cost-cutting story is a unique catalyst that its peers don't have. We think that gives them a clear shot to outperform everyone else, even if the whole industry is down. What could make it work? Stronger than expected holiday sales or any good news on tariffs. The risks? Well, customers could say no way to higher prices, or management could simply fail to execute the plan.
And one last time, remember, this is not financial advice.